Welcome to Unlock Your Life, guys. Today I'm going to dig into the mindset that I have around money, cash flow, passive investing. Should I buy and hold? Should I sell? The three types of rocks and income streams you need and how to get there. So let's dig into it. First and foremost, people get into real estate with the dream, right? The dream is the income stream. Everyone I talk to, they want to get into apartments or rental houses or self-storage or whatever, is because they want that recurring income stream. I want $10,000, $15,000, $50,000, $100,000 a month pouring in like clockwork. It doesn't vary. I can count on it. And every year the property gets paid down, it goes up in value. And it just hits all these pleasure centers in our brain of, wow, I'm getting like cash flow for free. I'm paying my mortgage down. I still have my golden parachute at the end when I sell or refinance my property. And it's going to be great, right? And I'll tell you, it is great. And there is a piece of your portfolio that needs to be just that. And I have that in my portfolio. It's kind of like my rainy day fund. It's my well, not rainy day fund, but my retirement fund. So I'm not heavily invested into 401ks and stocks and all that stuff because I don't understand it and I can't control it. And I've chosen to focus on as my business real estate. So why would I not utilize this vehicle for my retirement? It's also a great tax haven. I'm not telling you guys anything that you don't know, but where people get messed up is they forget about the two other buckets, right? You need money right now. Like you need money every week or every month to live, to pay your bills, to pay your mortgage, to pay your power bill, et cetera, et cetera. And you also need midterm money, every couple of years, every, 1, 2, 3 years where it takes a little longer to make this money. But when it comes, it's a decent sized chunk and then you're able to reinvest it. You're able to spend it on lifestyle if you want, and living expenses, or maybe you can use some of that to invest in some of this long-term stuff. But if you buy and hold everything and you don't have steady income coming in, right, from another job, like let's say you work a full-time W-2 job or whatever, you have a business, etc., but you have something that's bringing in money every month. If you buy and hold everything, that can be a recipe for disaster. And I've seen it time and time again in the real estate space. Somebody gets some real estate, they maybe prematurely quit their job, jump out of that steady income and say, well, I'm going to be a full-time real estate guy and I'm going to live off the cash flow. And maybe they have the cash flow at the time. But the cash flow can change, right? That durable income stream that you think is going to be there month after month after month, it's only durable until it isn't, right? Taxes go up, insurance goes up, buildings catch on fire, tenants leave, tenants squat, you can't get them out. Banks call notes, want you to refinance, terms end, rates go up, rates go down. Like there's so much risk in the market of staying in an asset. So I don't want you to think about it as this like, well, once I'm into an asset and I've refinanced out my money and I've got a loan on it, there's no more risk on that deal. Right? Well, yes, that's true. You don't necessarily have your personal cash tied up in that deal anymore and you can go utilize it for something else. But there is still real risk in that deal. There's operational risk. What if your property manager starts sucking or they die or they quit? You got to find a new one. What if market conditions change, right? And values pull back? We saw that in 2008. We've seen that in 2023 and 4 with rates going up and values declining. We're seeing like if you think real estate always goes up, it does given a long enough time horizon, but in a 5-year span, it's not necessarily going to go up. So if you're solely dependent on that income stream of your passive cash flow coming from your apartment complex or your storage facility or whatever, it can change. I know this because I've done it. I've owned properties. I've owned properties that were cash flowing great, and then all of a sudden they're not cash flowing so well. Our 208 unit out in Tulsa, Oklahoma, cash flowing $20,000, $30,000 a month. And then bam, our insurance doubled and it killed most of the cash flow on that deal. So buying and holding everything without having a substantial, replicatable, sustainable source of monthly income, it can be a mistake. So if you're on the cusp of like, hey, you've bought some real estate and you're getting some cash flow and you're thinking about making that leap, make sure that you're prepared, because the worst thing is to run out of money, to have to like sell off your portfolio, maybe in a distressed scenario, and go back and start over, right? You don't want that to happen to you. Second piece, right? I'm talking about the pops of money every 2 to 3 years. This is something that I feel like I did right in real estate. I scaled up to, 1,300 units, and then I started selling stuff, right? And those sales helped create runway and psychological safety for me to continue along that road. So my 12 unit, I only owned it for 18 months, the first deal I ever did, because I needed the cash. Like I wanted to liquidate the cash and use it to further my real estate career. And so I bought that for $250. I got an offer 18 months later for $418. I had to give the investor some of it, but I think I netted around $100,000 on that one deal. And I'm looking at my expenses at the time. I'm like, okay, this is going to last me, probably close to a year. Like I can keep on working on my dream and keep on working on my deal. Mobile home park, we bought it for $200. We put $150 into it, sold it for $700. Great upside, and took the cash out and plowed it back into the business, investing in other things, paying bills, et cetera, et cetera. And having liquidity is something that I really, really want to talk to you about. And this is something that has changed somewhat the way I thought about it recently. So about 6 months ago, I got on the phone with a legitimate billionaire. This guy had a ton of money. He had built a business, scaled it up to 70 locations, sold it, and made a bucket of money, a ton of money. And I'm talking to him about my portfolio. I'm talking about what I'm trying to do and just getting his advice and getting his insight on what he thought about my situation and where I was. And he said, look, Jennings, the goal is not to necessarily own as much real estate as you can or as much big of a business as you can in his instance. He said, I got an offer to sell my business and I didn't take it. He's like, and then the economy turned and I spent 7 years building that business back up to where it was when I got the offer, and I ended up selling it for about the same price 7 years later. And I went through all that work, all that risk, all that brain damage to basically net what I could have netted 7 years prior, and I could have invested that and I could have grown that and I wouldn't have had to deal with that. It's like, so there are cycles to things. Buying and holding and having the commitment, like I'm just going to hang on to this forever, it's like that's not always the best case. He says, because what's the goal? He said, my goal was to make $1.5 million a year, bomb-proof, rock solid, passively with very little work and no risk, or very little risk. He's like, I've way surpassed that. He said, but if you're spending more than $1 million to $2 million just living, existing, like paying your bills, going on vacation, etc. It's like there's something wrong with you. You need to audit yourself if you're spending more than that. But if you can get to $1.5 million a year, like you really don't need to be taking a whole lot of risks and doing a whole lot of things beyond that. Granted, this is coming from a guy that's a legitimate billionaire. And so if you do the math on that, it's like, okay, well, if I've got, $5 million and it's making me 8, 9, 10% a year, that's $500,000. If I've got 15 million, that's $1.5 grand or 1.5 million a year. And so the goal, or his goal, was not to build out his business as much as he could or buy as much real estate as he could. His goal was, if I hit like 15, 20 million, I'm going to protect that. I'm going to put that into something that's liquid. I'm going to put that into something that is going to pay me consistently every month, like something that's very, very safe, aka treasuries, bonds, dividends, stocks, He was looking at our debt fund, which very, very consistently pays 10% per year, and in first position lien, so very good risk profile for him, and that's what he was looking to do. And it got me thinking, the goal is not necessarily a $500 million real estate portfolio. The goal is not to be collecting all this rent per month and have all this free cash flow, because I'm still exposed to risk, I'm still exposed to debt, et cetera, et cetera. And so the goal should be to have enough liquidity to set a base, right? And he's at $1.5 million. My number may not be that high. Maybe your number is $100,000 or $200,000 a year. Pretty attainable, $1 to $2 million getting you 10% a year is getting you $100,000 to $200,000 a year, right? And let's just say you want to go ultra conservative, go into bonds or treasuries. Okay, so you need $2 to $4 million to make that same $100,000 to $200,000 a year. And so I started to think about that and look at my portfolio, and I'm like, okay, I've got these 6 or 7 properties that are gems. They're easy to run. There's not a whole lot of risk on them. They're consistently making cash flow, and they're easy to manage, and they're in good areas, and I want to keep them. I want to hang on to them because I do want to have that golden parachute in year 15, 16, 20 years into this. 15 years from now, right? I'll take an example for you. The 73 unit in Moncks Corner, South Carolina. It's worth about $6 to $7 million today. We're getting about $86,000 a month in rent coming in, and we have debt on it. We have expenses, but it is cash flowing consistently $8,000, $9,000, $10,000 a month. If I take that out 15 years down the road, we're talking probably collecting $150,000 to $160,000 a month in rent. That's with 2 to 3% rent growth. And we're talking about the mortgage being very little, probably less than $1 million at that point. And if the NOI is where it is with those rents, the valuation of this building being, $13, $14, $15 million, right? And pretty much paid for. And so when I want that, right? And I'm going to want the consistent cash flow it's generating at the time. And if I want to sell it at that point, I want to be able to take that capital and do something with it. And so there's definitely a place for holding stuff long term. I'm doing it myself. And I try to tell people, not do what I say, but look at what people are doing. People say all sorts of things, but look at what they're doing. That's why I want to share with you something that I'm doing and a shift I've had recently. So I decided to take down a development deal because I have a lot. I've got this dental office, I've got this retail, I've got these multifamilies, I've got self-storage. Those are all someday money down the road, and yes, they spit off some cash flow, but sometimes it's up, sometimes it's down. It's not stuff that I feel is bomb-proof. Sometimes I got to reinvest the cash flow into repairs and maintenance, and you get it if you're a landlord. You understand what I'm talking about. And so I got this project I'm working on. You may have seen a reel on it or something, but it's 4.5 acres, and we're able to actually now fit 35 units on it. We were going to do 33. We got 35 units. I can sell these units for $250,000 a piece. We're going to do a separate TMS number and do a condo and sell them off to the end user individually. If you multiply 35 times 250,000, that's $8.75 million. Okay, so large project, and the cost of the project is going to be about 4 to 4.2. So let's just say things go badly, it takes longer than I hope, et cetera, et cetera. We're hoping to still at least net $4 million on this deal, of which I own 75%. And that's $4 million after paying investor stake and splitting it with the deal or with my partner. And so people have asked me, Jennings, you could rent these bays out for $2,000 a month. You could get $70,000 a month in income coming in, and all your expenses would be your taxes and insurance. And why don't you just keep it? It's going to be brand new. It's going to be low maintenance, on and on and on and on. And yes, that's true. But the way I see it is where I'm at is I've already got a lot of that stuff. That's the long-term stuff. That's the cash flowing stuff. And what I want now in this cycle of where I'm going in real estate is I want liquidity, right? And so the thing that I have my eye on for this liquidity is the debt fund that I'm a co-GP on. So I'm a co-GP on this debt fund, and amounts over $1 million earn 10%, and it's paid monthly, or you can let it accrue and compound. But let's just say we're taking distributions monthly. On top of that, I'm a co-GP, right? So I'm getting a slice of the profits of the fund. And so what this ends up equaling is about 13 to 14% on the money in this fund. And this fund is in first position loans, pretty much the safest debt you can be at 65 to 75% leverage. And I feel very strongly about the operators. Kelly Garrett, an amazing woman. Rehab Wallet is the lending arm. And so let's just take $3 million times 13%. That's about $390,000 a year of income that I can count on, right? I could, if it's more than I need, like I'm making money from other things, okay, I can just let it compound and grow. If it's not, I can turn those distributions on and I can get them in. If for whatever reason I need $1 million, or I need $500,000, or I need $200,000, I can call Rehab Wallet and say, hey, I misestimated my taxes. I got a tax bill. Can you send me 100 grand? Can you send me 200 grand? Can you send me 500 grand? Within a few weeks, they're going to send that to me. They're going to wire that to me. This is something like I can't go to that dental office and pull my equity back out of that dental office. I can't go to my Monk's Corner apartment complex and pull $1 million out of that very easily. I'm not saying you couldn't do that somehow with credit lines or selling your shares to other investors and liquidating, but real estate is definitely more illiquid than, say, stocks, bonds, money markets, debt funds, etc. So, and I think about like my quality of life, my peace, like what would it look like? You know, I have liquidity now, but a lot of that liquidity I loaned out on hard money loans. And once you loan that out, it's not liquid anymore. Yes, it's making a return. Yes, it's paying you the monthly cash flow. But if you need it, you can't get it. And so as I've gotten older, that liquidity has become more and more important to me, of having access to funds at the drop of a hat and knowing that it's going to be there, that it's in a safe investment, and I can count on it. And that helps you relax. It helps you take more risks, right? If I have this rock set up that's paying me a $400,000 a year base salary, that helps me to take more risk. Like, you know what? I'm going to take on this deal. I'm going to start this business. I'm going to invest in this. I'm going to do this. Because I know I'm keeping the lights on. I'm paying my mortgage. I'm paying my electric bill. I'm putting food on the table. My wife's not worried about stuff. How are we going to pay for the kids' private school, et cetera, et cetera. And I know those costs are real. And so that is why I've decided to sort of kill the golden goose in the regards to the storage or the flex warehouse space, generate that liquidity. And man, if it goes great, if it goes as well as I hope it will, who's to say I can't build another one? And then that one, I can own the whole thing, and I can rent those units out, and I can get the cash flow from that. And then I build another one. Maybe I sell that one off, right? There's a balanced approach to this, but liquidity is extremely important. Durable monthly cash flow is extremely important. Yes, you're going to get the large payday at the end of the road down 15, 20 years from now, and it's important to plan ahead for that and have that, but don't forget about the short-term and the mid-term money and how important it is to be liquid as a real estate investor. All right, guys, that's what I have for you this week. Have a great week, and we'll talk soon. Unlock your life. Peace.